Welcome to our channel. Disability insurance replaces income if you can't work due to illness or injury. Follow these step-by-step instructions to choose between short-term and long-term coverage. Step 1. Understand the difference between short-term and long-term disability insurance. Short-term typically covers 3 to 6 months, while long-term covers years or until retirement age. Step 2. Evaluate your employer's disability benefits first. Many employers offer group coverage, which is often less expensive than individual policies, but may have limited benefits. Step 3. Calculate how much coverage you need by determining what percentage of your income you must replace to maintain your lifestyle. Most policies replace 60 to 70% of gross income. Step 4. Review the elimination period, which is the waiting time before benefits begin. Short-term policies often have 0 to 14-day waits, while long-term policies typically wait 90 days. Step 5. Compare own occupation versus any occupation definitions. Own occupation policies pay if you can't perform your specific job, while any occupation only pays if you can't work at all. Step 6. Check the benefit period, which is how long the policy pays benefits. Long-term policies can pay for 2 years, 5 years, to age 65, or for life. Step 7. Consider inflation protection riders that increase benefits over time to keep pace with rising costs. This is especially important for long-term policies with extended benefit periods. Step 8. Get quotes from multiple insurers and compare premium costs, benefit amounts, definitions of disability, and exclusions. Individual policies cost more, but offer better protection and portability if you change jobs. Don't forget to like this video and subscribe to our channel.